Good morning. My name is Leah Kratz, and I'm one of the co-authors of your financial accounting textbook. By now, hopefully you've had a chance to read through Chapter 12, and you've discovered we're talking about investments. Unlike any other place in accounting, investments are fascinating because we have so many different options and methods for reporting the same exact asset. Nowhere else do we see this. The way we account for the investments in other companies is really determined by multiple things. It's the level of investment, the type of investment, and our intention with what we think we're going to do with that investment. Hopefully, as you were reading, you were able to think of your top 5 items. I've thought of mine, so let's get started. For me, number 5 was the concept of return on assets. Now, this is an indicator that a lot of people use to analyze an organization and how well they're doing. It's really a measure of how well they're using their assets to work for them and thus generating a return. Obviously, assets take something to acquire. There's a cost to them. And so we want to make sure when we make those investments that we're actually getting a return on that and we're using those assets to help us generate more revenue. The way we calculate return on assets is taking our net income and dividing it by our average asset balance. Again, decision makers are trying to choose between different investments and they're trying to determine what's the best use of their funds, whether they are an investor or a creditor, and where they should invest those. This is an important figure that a lot of people look to make that decision, and for that reason, I wanted to place return on assets as number 5 most important thing in Chapter 12. For me, the 4th most important thing in this chapter is the concept of equity method accounting. Now, equity method accounting is not something that we encounter widely, but it is used in very specific instances. Equity method of accounting is very different because it pays no attention to fair value. Instead, the company that has the investment is recording income when the investee records income. This is very different and unlike anything we see in other areas because the company that's invested hasn't actually received anything yet, but yet they're still recognizing income and an increase in their investment account simply because the company they've invested in has reported income. Now, when do we report equity method? Well, when we invest in the equity shares of another organization, but we do so at a level at which we can apply significant influence, we're required to use equity method of accounting. And this level of investment is considered somewhere between 20 and 50% ownership. Now, those are not hard and fast rules. They're guidelines. It is possible to have less than 20% ownership but still have significant influence, as well as it's possible to have more than 20% ownership but not have significant influence. So there has to be some analysis done in addition to just simply looking at the percent of ownership. But when the equity method is determined to be used, again, when something happens to the company that we're invested in, we also report a corresponding change on our books. We talked about when the investment company earns an income, but let's also talk about when they report dividends. Those dividends are a distribution of wealth. We're taking it out of the company and distributing it to the owners. In that case, when dividends are paid, the actual size of the company shrinks and goes down. So when the company who's invested in that organization receives those dividends, it would be inappropriate to record revenue again. So instead of reporting revenue and net income increasing, the actual investment will decrease with the receipt of dividends under the equity method. Again, the company we've invested in, the size of that company is decreasing with the distribution of dividends, so therefore we'll have a corresponding change that's similar in our own investment account. Because of the nature of this transaction and the uniqueness of equity method accounting, I placed this as number 4 as my top important things in Chapter 12. So this brings us to number 3 on my list of the most important things in Chapter 12. And on my list, I considered this to be consolidated financial statements. Sometimes a company will invest in the equity securities of another organization to such an extent that they actually gain control of that other company. In the United States, we consider control to occur when 51% or more of the shares are acquired. Now, this is actually a very advanced topic in accounting and one that you'll look at more detail in upper level accounting classes, but it is important for you to be familiar with that it does occur and some of the basics of the consolidated financial statements at this point. So when an organization acquires another company, the financial statements of each of those organizations need to be consolidated into one report. And the way we do that is by combining the totals of the assets and liabilities of the parent with the assets and liability totals of the subsidiary. But there are some differences between the two. The book value of the parent's assets and liabilities are used, but the fair value of the assets and liabilities of the subsidiary are used in those consolidated financial statements. And it's the fair value at the point the acquisition was made. We do not continue to change for fair value of the subsidiary, but only we recognize the fair value at the point of acquisition. The value of assets and liabilities at that point are combined and with the book value of the assets and liabilities of the parent, and that's how we get the totals. Now, of course, we also know that in an acquisition, goodwill could be created. Goodwill is the price that the parent company pays above and beyond the book value of the assets and liabilities for the subsidiary. And the reason they would pay more is because there are things of value that the subsidiary has, but just are not recorded in the financial statements. For example, that might be customer loyalty or a good reputation in the community. Those things have value, but we don't record those on financial statements. And the parent company is willing to pay for the value of those things, those intangibles, and we call that goodwill. So in consolidated financial statements, you'll see the assets and liabilities of both companies being combined, but you'll also see the creation of goodwill. And we know that we don't amortize goodwill, but rather we do check for impairment every year after acquisition. The last thing to note about consolidated financial statements is that the revenue and expenses incurred by the subsidiary after the point of acquisition are also combined with the parent's revenues and expenses. Any revenue and expense that's incurred prior to the point of acquisition would not be included because that would be separate. But after the point of acquisition, any revenue generated and any expenses incurred would be consolidated with the parent's revenue and expenses on those consolidated financial statements. Again, consolidated financial statements is a very important topic, and so I placed that as number 3 on my list for Chapter 12. For me, the second most important thing in Chapter 12 is the idea of equity investments. Now, this is where a company will take excess funds and invest them in the shares of another organization and will actually obtain part ownership. Now, these investments are not significant in size to the point that they would be able to exercise significant influence or control. These are just investments to have excess cash invested to help work for them until that cash is needed. Now, equity investments are reported on the balance sheet at fair value, which means if the price of those shares increases, we're going to increase the amount reported on the balance sheet. And if the price of those shares goes down over time, we'll decrease the asset account balance accordingly. Now, when we adjust for fair value, any gain or loss is then reported in the income statement as a gain or a loss. The reason for this is because with equity investments, we have the ability to know at any point in time what those fair values are, and we have a market available to sell them should we want to. That's unlike other assets that we've explored, where either we may not know the value at any point in time, or we might not have a ready market available to sell those assets. But with equity investments, we do. We have a market such as the New York Stock Exchange or the NASDAQ, and we are able to know the price and we're able to sell them at any point in time. Because of that, we do allow those changes in fair value to be reported directly to net income as a gain or a loss. When we receive dividends on those investments, those dividends are recorded as revenue in our net income. So again, we have two ways that equity investments will impact our net income, either through the gain or loss and change in fair value, as well as the increase in net income due to dividends. The last thing we explored with equity investments was what happens when we sell them. At the point of sale, we will record the proceeds, whatever it is we received for them, and we'll remove that investment from the books. Any difference will be reported as a gain or loss on the income statement. Now, what's important to note is that gain or loss on the income statement is only the changes in value for the current period. Recall that any changes in fair value in prior periods would have already been recorded in net income. So the only difference that needs to be reported are current year changes in value. Because equity investments are so plentiful and because of the impact on the financial statements, I reported this as the second most important thing in Chapter 12. And this brings us to the top item on my list for Chapter 12. And on my list, I considered this to be the accounting for debt investments. An organization has the option to invest excess funds in debt instruments of another organization rather than the equity. When they invest in equity securities, they're actually gaining part ownership in that company, which is not the case with debt investments. When a company invests in debt instruments, they're simply investing the money with the expectation that it will be repaid with interest. The benefit to this are stated rates of interest and known returns. The trade-off, though, is that you forego the opportunity for unlimited increases in stock prices and the payment of dividends. There's a risk and a reward trade-off, as we typically see in investments. But what makes debt investments so interesting is that we have a couple different methods to account for them depending on our intentions. If we intend to sell the debt investment rather soon, we classify those as trading securities. The way we treat trading securities is very similar to how we would treat the accounting for equity investments. We're going to report them at fair value, with any changes in fair value being recorded as a gain or loss on the income statement. As you recall, that's probably very similar to what you saw in equity investments. When the value of those instruments go up, we increase the investment account, and subsequently we will record a gain on the income statement. Conversely, if the value goes down, we decrease the investment account and we would recognize a corresponding loss on the income statement. Now, you don't receive dividends with a debt investment, but you will receive an interest payment, and those interest payments would be revenue and would increase net income as well. Where it begins to become very interesting and very different is when we do not intend to sell those debt instruments in the near future. We may intend to sell them, but it's at some unknown point, could be months and could be years from now. When that happens, we classify those investments as available for sale. And the accounting treatment for available for sale becomes very different. Again, we will record the value on the balance sheet at fair value, but rather than having the gains and losses flow to net income, we actually record those changes in the equity section of the balance sheet in an area called Accumulated Other Comprehensive Income. Now, this was a brand new concept and nothing that we've seen before in our financial accounting coverage, which is why I thought it was one of the most important topics in the chapter. The reason we don't put the gains and losses in net income is because it would be premature. We might not sell these investments for some time, and therefore the value is likely to change quite considerably from the point we are reporting to the point we actually sell it. For that reason, it's premature to put the gains and losses in income. It's not a done deal yet. And for that reason, we put it in stockholders' equity under Accumulated Other Comprehensive Income. The next thing we want to talk about, though, is what happens when we sell those investments. When we sell debt investments that are classified as available for sale, we're going to record the proceeds and remove the investment from our books. But the difference, the gain or loss that's going to be reported in net income will be the full amount of the gain or loss or change in value from the point we acquired the investment to the point we sold it. Remember, all of those prior changes in fair value have not hit net income yet. So we want to report any changes from acquisition to the point of sale will now be put in net income, which that's a big difference from what we had seen before. So as you can see, investments are really an interesting topic. We have the equity method of accounting, we have consolidated financial statements, we have equity investment accounting, we have accounting for debt instruments. There's lots of different methods for accounting for this asset that we call investments, and it all depends on our intention, the type of asset, and the level of our investment. No other place in accounting do we see so much diversity in accounting treatment for just one particular asset, and that's what makes this such an interesting chapter. I hope you're learning a lot. I hope you're seeing how a lot of these things are coming together. I hope you're able to look at a set of financial statements and really start to understand what it is you're seeing, understanding the terminology that's being used. And I hope you're able to understand what's being communicated in those financial statements. Financial accounting is all about telling a story of what's happening in that organization and using that information to make good decisions. I hope you're finding you're able to do that more and more with each chapter.